You probably already know a lot about ICT. You probably already understand fair value gaps, order blocks, and liquidity. But what if I told you that this is not enough to become consistently profitable, and that the real secret to becoming profitable is by trading a mechanical rule-based trading system? A system that takes all of the guesswork out of it, a system that removes all of your emotions, and a system that is simple and easy to follow. Well, in this video, I'm going to cover the one ICT trading strategy for life, and I've broken it down into a simple, easy to follow framework where everything is systematic and everything is defined. I've broken the system down into two steps. Step number one is time frame selection, and step number two is the power of three. The most important thing to begin with is time frame selection. And a question that I want you to ask yourself is, do you know what type of trader you are? And if the answer is no, then I need you to work to understand what type of trader you are. Because when I first started trading, I wanted to get into swing trading. But then I realized that I didn't have the patience, and I realized that there wasn't enough setups for my strategy. At the end of the day, I'm not here to tell you what type of trader you should be. That really is for you to understand. However, these are the three types of traders. So as a trader, you primarily fit into these three buckets. Number one is a swing trader, where you're primarily analyzing on the weekly and daily, and you're executing on the 4-hour time frame. Number two is a shorter term or kind of hybrid style trader. This is really the bucket that I fall into. This is where the majority of your analysis is on the hourly and 15-minute, and your execution is mainly on the 15-minute time frame. What I've found is this is kind of a good middle ground between swing trading and scalping. It's fast enough to where you're still getting a lot of different setups, but it's still slow enough to where you can make accurate logical decisions, and you're not getting too emotional like sometimes when you're on the 1 minute or 5 minute. And that leads us to number three, which is a scalper. This is where you're primarily going to be executing on the 1 minute and 5 minute. And what I found really with this is I was getting way too emotional. Not only that, I found that my chart time was absolutely through the roof, and that's why I kind of gravitated towards more of a hybrid style system. Please note the lowest time frame is only used for execution of the trade, and your bias should not change unless there is a change on your higher time frame. So for example, let's say you are a swing trader, you're analyzing on the weekly and daily. Your higher time frame would be the weekly time frame, and therefore you would need to see a change on the weekly time frame in order to invalidate your bias. All right, so this is step number one, which is time frame selection. And honestly, this is the most important part of the system, and you really need to understand what sort of trader you want to be. But not only that, you need to trade a system that revolves around your life. Let's say that you have a full-time job or you're in full-time education. Well, what I've found is often scalping is not going to be too suitable for you, because most people do not have the time to sit down at the charts for hours every single day. And therefore, if you are working full-time or are in full-time education, then more of a hybrid or swing trading style strategy would be very, very beneficial to you. All right, cool. So that is time frame selection. Now let's look at the power of three. This is where we're going to look at more strategy-based concepts. And time frame selection was amazing, but if you don't understand this concept, there's no way you will ever become profitable. So I've broken down my strategy in an easy to follow step-by-step system where all of the parameters are defined. And I'm going to be honest with you guys, if you cannot break your system down into a flow chart like this, where the answers are kind of yes or no and black or white, and therefore it's very likely that you're taking a discretionary approach to your trading. And that means that you're relying on your intuition and emotions to make trading decisions. And to be honest, that is why most traders fail. Okay, so my system starts right here. And the first thing that you need to ensure is that you have a clear daily directional bias. That means when you turn up to the market, you need to know, are we looking for longs here or are we looking for shorts? If you do not have a clear daily directional bias, then guess what, guys? You should be doing absolutely nothing. You should be only executing trades when the market conditions are just right and when you have a clear daily directional bias. If the answer is yes and you do have a clear directional daily bias, you can start gearing up at looking for a trade. However, you still need to wait for the next confluence. The next thing that you need to ask yourself is, are we during a kill zone? All right, so let's say that we are long bias on this market, and let's say that we see a run of sell side liquidity. One of the most common questions that I always get asked is, when should you be looking for liquidity raids? And the simple answer is when the most amount of liquidity is actually in the market. And there's 2 times across the day when this occurs. You have the highest volume session, which is the New York session. And let's say that this right here is your kill zone. You need to be executing during this time window right here, which is 8 until 10:30 a.m. New York time, or the London session kill zone, which is between 3 a.m. and 5 a.m. New York time. You know, just think logically, like, when is the most amount of participants active within the market? And this is your answer. It's literally during these 2 sessions. So when should you be looking for liquidity raids? It's during these 2 kill zones, and that's when you're going to get the highest probability setup. All right, so let's say the answer is no and you're not during a kill zone. Then there's not much liquidity available in the markets, and therefore you should be doing absolutely nothing. If you are during a kill zone, you may have guessed it, but we need to wait for the next confluence. But we're starting to go down the process right here. The third confluence is the ICT power of 3. And all that simply means is, let's say that we have liquidity built up right here. We have liquidity resting above these highs. We have liquidity resting below these lows. An ICT power of 3 would be during or just before a kill zone. We see a raid of liquidity. It's at this moment when we can classify this as an ICT power of 3, but this is where so many traders go wrong. Like, how do you actually know if this is a liquidity raid, or how do you actually know if this is a breakout to the downside? And this is where I like to use something called displacement. So let's say that you see this run of sell side liquidity right here. Well, what we need to see is a strong injection of bullish pressure, and this would be your displacement right here. So if price displaces to the upside once we've seen a run of sell side liquidity, this then shifts the probabilities in our favor, and this increases the chance that this actually is the bottom in the market. And if we do have a bullish bias on this market right here, then it's extremely likely that price is going to then go on and run buy side liquidity, and therefore we're going to see a distribution in price. And so this solves one of the biggest issues that traders are facing. Let's say that your sell bias on the market, you see a ICT power of 3 raiding buy side liquidity right here. Well, how do you know if this is actually a valid raid on liquidity, or how do you know if this is actually a valid breakout to the upside? Well, if once you've seen a raid on liquidity, if we then see a displacement, strong displacement to the downside, this then puts the probabilities in our favor that this is the high in the market, and therefore we can expect the distribution in price to see lower prices. So I can't stress enough how important it is to wait for this displacement, and it's this displacement right here that is your strong confirmation. You may ask, well, how do we define a displacement in a mechanical framework? And let me just break that down for you step by step. So let's take this scenario right here. We're bullish in the market. We see a raid of sell side liquidity. Well, let's say that we wait for a 15-minute bullish confirmation. This 15-minute bullish confirmation is actually a form of displacement, because the 15-minute bullish candle is of course broken up into 15 1-minute candles. And therefore what this is going to look like on the smaller time frames is it's going to look exactly like this. It will be bearish on the 1-minute or 2-minute time frame. However, once we see a 15-minute bullish confirmation, I can assure you that 99% of the time, the 1-minute or 2-minute will be breaking market structure to the upside, and you will also have a form of displacement on the 1-minute. So this could be in the form of a fair value gap, and this is also in the form of a market structure shift. So I'm here to tell you that you don't need to be dropping down to these 1-minute or 2-minute time frames, and that just using this 15-minute confirm right here is actually an indication that the smaller time frames will have displacement. The 1-minute will be shifting from bearish to bullish, and it's extremely likely that there's going to be some form of fair value gap on the smaller time frame. And so the reason why I'm explaining this is the fact that you don't need to actually drop down to the 1-minute and 2-minute time frame, because the 15-minute actually tells you everything that you need to know. And so this is our final piece to the puzzle. Once we've seen the displacement in price, we can then look at entering a position. Invalidation will go below the liquidity sweep, and we can simply target a mechanical 1 to 2 or external range liquidity up at the highs. I personally like to use a mechanical 1 to 2 risk to reward. This is because I prefer a more mechanical and hands-off approach. So again, no displacement. Guess what? We've got no trade right here. If we see displacement in the market, i.e. from a 15-minute bullish close, or if you're very degenerate, you can drop down to the 1 minute or 2 minute. And then guess what, guys? You take the trade without any hesitation. And so this leads me on. The reason why traders hesitate to take a position within the market is because they're not following a rule-based systematic approach like this one. And so by the time that you get to the end of the process, because you've seen all of your confluences take place in front of you, there's literally no hesitation within the market. And so this is how you really become confident as a trader. And then of course, you take your trade and it's either a win or it's a loss, and you're at the end of the process. And I repeat this process every single day. This is the exact process that has allowed me to get funded over $600,000. And so if it's worked for me and it's worked for many of my members, I believe it can work for you too. And so this right here is the one ICT trading system for life. First, understand time frame selection, and then understand strategy. Just to summarize, you need a clear daily bias. You need to be executing during a kill zone. You need to see an ICT power of 3, and you need to see a form of displacement as a confirmation. If these 4 confluences line up, you have a high probability setup. If you haven't already, guys, then make sure to join my free Discord community. The link is in the description down below. And if you're looking at becoming funded and consistently profitable in less than 90 days, then make sure to check out my one-on-one mentorship. As always, thanks so much for your time and support. Take care, guys. Bye-bye.